This John Lothian news video is sponsored by
How have family offices evolved, and how are they incorporating alternative investments?
With single-family offices, a lot of them, were business-owning families. They were bricks-and-mortar families, but then they had liquidity events. The M&A market really exploded, and now it's, as I call it, liquidity. Now what? Now what do you do? And that caused, I think, an explosion also into the hedge fund. And that was clearly a 90s boom, a technology boom, a venture boom, and even though we had 01, the beginning of end of 2000 into 01 with the technology bust. I mean, look at where we are today. We have a very, I always say fear has a very short-term memory. And then, you started to get more into the exotics and the credit strategies and ways to make money because markets were getting flatter, right? So you kind of wanted to see, and that's where I think you saw more of a desire to look outside the long short.
How do you get family offices to incorporate managed futures into a portfolio?
I think with the families and managed futures, sometimes it's education. It's really understanding what managed futures are, what components make it up. The systematic programs can be very difficult, to really get your head around that black box. And it makes some families very nervous. And I always said when I was picking managers to invest in, if you can't explain it to me so I can understand it, then I'm never going to recommend it. And so I think there is that kind of thing. And understanding managed futures is an umbrella term for CTAs and and why isn't it just CTAs? Why do we call it managed futures? Why don't we just, So there's a little bit of a disconnect there. I think it's going to be about education. For families, it's always about education. I think the more they know, the more likely they are to see the opportunity to invest.
When seeking an allocation from a family office, what mistakes do CTAs typically make?
The big mistake most managers make is they don't explain their risk, and they really don't give you a lot of clarity on the back office because it's a business, it's not just a fund. And a lot of what happens is the business risk blows up. Managers need to be very clear on how the business is set up. Who's looking over their shoulder to make sure that they are honest? Who are the vendors they're working with? Are they reputable? Right? I mean, so I think that's the thing. A lot of managers don't make a point of really explaining that. If you go to an institution, a pension and an endowment, boy, are they going to drill down.
Are there any more differences between family offices and other investors?
Families are always thinking about the transferring of wealth. They're thinking about estate planning. They're thinking about tax strategies. It is ingrained in what they do because their goal is to move it to the next generation and have it sustainable for the generation after that. So you have to take advantage of tax strategies that will allow you to do that. I think the bigger issue is ordinary gains versus capital gains. And I think that is a concern. And so the short versus the long, I think they do really think about that and how much in their portfolio they're willing to assume. There is a difference between estate planning and tax, managing the wealth for estate strategies and managing the wealth for tax strategy. But a family will try to take advantage of both of those. And so it does make a difference. And these guys, if they built their money, they built their business, they're always looking at taxes in some form or another. And I just think it carries through on their investment.